Welcome everyone to our Academic Banking podcast, where today we delve deep into the world of modern central banking under the theme, navigating the new age of monetary policy tools, effectiveness and implication of unconventional approaches. I am Consumin and I will be your moderator. Since the 2008 global financial crisis and again during the COVID-19 pandemic, central banks worldwide have resorted to new, non-traditional monetary instruments when conventional interest rate policies proved insufficient. The transformation has sparked significant debate in economic policy circles. Today's discussion explores three major unconventional monetary policies. We will evaluate their mechanism, practical application, effectiveness, and the broader socio-economic implication. Before we begin, let me outline the panel rules for today's discussion. Each panelist will have a maximum of 3 minutes to answer each question. If a panelist exceeds the allocated time, I will politely move the discussion forward and pass the question to the next panelist or the topic. This format ensures a dynamic, focused conversation and allows us to cover a broad range of perspectives within our limited time. Let's meet our expert panelists. Yishomo, we begin with you.
Thank you, Kunzo. I am Yishomo. My research focuses on post-crisis monetary strategy in the United States. Quantitative easing, or QE, is arguably the flagship unconventional monetary policy. When policy interest rates are close to or at zero, quantitative easing enables central banks to purchase long-term securities from the open market. This increases money supply and lowers long-term interest rates. If I give you a real-world example, the US Federal Reserve deployed quantitative easing in several phases from 2008 to 2014, purchasing over $3.5 trillion in treasury and mortgage-backed securities. This had a dual goal: restore market liquidity and stimulate economic recovery. Though effective in many areas, it contributed to raising asset prices, thus raising concerns about increasing inequality and financial market dependency on central banks.
Thank you, Ishe. Let's move on to the next panelist, Yishomo.
Thank you, moderator. I am Yishomo and I'll be presenting on negative interest rate policy, or NIRP. This policy involves setting nominal central bank interest rate below zero to motivate banks to lend rather than park their funds at the central bank. For instance, the European Central Bank implemented NIRP in 2014 with rates dropping to negative 0.5% by 2019. While NIRP encouraged lending and weakened the euro, supporting exports, it created several challenges including squeezed bank margins, asset bubbles and distorted risk assessment.
Now let's move on to the final panelist, Ishi Kalindema, your insight on the forward guidance.
Thank you. I'm Ishi Kalindema and I will be focusing on monetary communication and expectations. To talk about forward guidance, it is a policy where a central bank manages market expectations through explicit communication of future policy intentions. The Bank of England in 2020 announced that it would not raise the rates until inflation reached a certain 2% and unemployment conditions were strong. Forward guidance helps anchor expectations and reduce uncertainty. However, its success depends on the credibility and clarity of communication. Miscommunication or overly rigid guidance can backfire.
Let's start with question and answer session, so please be reminded of the timing. Yishomo, critics argue that QE has increased inequality. Could you please elaborate on that?
Thank you. Quantitative easing (QE) was introduced as a crisis-fighting tool, but its impact on inequality has become one of the most debated aspects of modern monetary policy. At its core, QE involves central banks purchasing large quantities of government bonds and other financial assets from the market, injecting liquidity and driving down long-term interest rates. While this supports economic recovery by making borrowing cheaper, it also has profound distributional effects. The most direct channel through which QE increases inequality, is asset price inflation. When central banks buy bonds, their prices rise and yields fall, pushing investors into riskier assets like stocks and real estate. According to the Federal Reserve, from 2008 to 2020, the value of US household financial assets grew by over $30 trillion, with the top 10% of households capturing more than 70% of these gains. For example, during the third round of QE in the US, the S&P 500 index surged by over 30% in 2013 alone. Meanwhile, wage growth for the bottom half of others stagnated, and home ownership rates among young and lower-income Americans fell to historic lows. Additionally, ultra-low interest rates hurt savers, especially retirees and pension funds, who rely on fixed income returns. In the Eurozone, the ECB's QE program contributed to a 40% increase in stock market capitalization between 2015 and 2019. But the Gini coefficient, a measure of inequality, also rose. In summary, while QE stabilized economies and prevented deeper recessions, it also widened the gap between asset owners and non-owners, raising difficult questions about the fairness and long-term consequences of such policies.
Thank you, Ishe, for that comprehensive analysis. It's striking to see how the very policies designed to prevent economic collapse can have such uneven impact across the society. The data you mentioned, such as that 30 trillion increase in the US household assets and the disproportionate benefit to the wealthiest, really highlights the need for policymakers to consider not just the macroeconomic impact, but also the distributional consequences of unconventional monetary tools. Perhaps this is a call for a closer coordination between monetary and fiscal policy to address these disparities. So to the next panelist, what are the long-term risks of NIRP?
Thank you for your question. Negative interest rate policy is one of the most unconventional and controversial tools in the monetary policy toolkit. By setting policy rates below zero, and central banks essentially charge commercial banks for holding excessive reserves, hoping to stimulate lending and spending. However, the long-term risks of NIRP are significant and multifaceted. First, bank profitability is severely challenged in Eurozone. For example, the average return on equity (ROE) for banks fell from 8% in 2007 to just 5% by 2019, with some banks even reporting negative returns. This largely because the banks are unable to pass negative rates onto retail depositors, compressing their net interest margins. Second, NIRP can encourage misallocation of capital. Banks, in an effort to avoid negative returns on reserves, may lend to riskier or less productive firms, leading to the rise of so-called zombie companies. According to the Banks of International Settlements, the share of zombie firms in advanced economy doubled from 4% in 2007 to nearly 10% by 2019. Third, investors desperate for yield may pour money into riskier assets, inflating bubbles in equities, real estate, or corporate bonds. For instance, after ECB introduced NIRP, European high-yield bond issuance hit high records and real estate prices in major cities soared. Finally, NIRP can have unintended consequences for savers, pension funds, and insurance companies, all of whom struggle to meet long-term obligations in negative rate environment. In sum, while NIRP may provide short-term stimulus, its long-term risks to financial stability, bank health, and capital allocation cannot be ignored.
That's a sobering perspective, Ishe. The data on bank profitability and the rise of zombie firms really underscore the unintended side effects of negative rates. It seems that while the NIRP can provide a temporary boost, it may undermine the very foundations of banking and financial stability if used for too long. This raises important questions about the limits of monetary policy and the need for the structural reforms to support a sustainable growth. So, the next panelist has a forward guidance worked effectively in emerging markets.
Thank you. Forward guidance is a communication strategy where central banks signal their future policy intentions to shape market expectations and reduce uncertainty. Its effectiveness in emerging markets has been mixed, largely due to differences in institutional credibility, economic volatility, and external vulnerabilities. For instance, the Reserve Bank of India began issuing explicit inflation forecast and policy guidance in the early 2010s. This helped anchor inflation expectations as seen in the narrowing gap between RBI's forecast and actual inflation rate from the average deviation of 2.5 percentage points in 2010 to just 0.8 points by 2018. However, emerging markets often face challenges that undermine forward guidance effectiveness. Political interference, frequent supply shocks, and external pressures like capital flows can disrupt the transmission of guidance. In Brazil, for instance, the central bank's credibility was tested during periods of political turmoil, leading to sharp swings in bond yields despite forward guidance. According to International Monetary Fund, only about 40% of forward guidance announcements in emerging markets between 2010 and 2020 had a significant measurable impact on markets. Thus, while forward guidance can support policy transparency and predictability, its success in emerging markets is contingent on strong institutions, credible communication, and the ability to adapt to shocks.
The next question is, Japan used QE early. What lesson can be learned to the reshape?
Okay, so Japan was a pioneer in the use of quantitative easing, launching its first QE program in 2001 in response to persistent deflation and stagnation. The Bank of Japan expanded its balance sheet by purchasing government bonds and other assets, hoping to spur lending and inflation. While QE helped stabilize financial markets and prevent a deeper downturn, its impact on real economic growth was limited. Between 2001 and 2020, Japan's GDP growth averaged just 0.7% per year compared to 2.5% in the US during the same period. Inflation remains stubbornly low, rarely exceeding 1%. Despite the BOJ's efforts, one key lesson is that QE alone cannot overcome deep structural challenges.
Those are important insights, Ishe. Japan's experience reminds us that monetary policy, no matter how unconventional, cannot substitute for fundamental economic reforms. The data on Japan's slow growth and low inflation despite massive QE highlight the limit of what central banks can achieve on their own. This lesson is especially relevant for other countries facing similar structural headwinds. So the next question is, could NIRP be viable for countries like India or Brazil? Ishomo.
Okay, to answer your question, implementing negative interest rate policy in emerging economies such as India or Brazil would be highly challenging and potentially destabilizing. Unlike advanced economies, emerging markets often grapple with higher inflation rates, volatile capital flows, and less developed financial systems. For instance, India's inflation averaged 6.2% between 2010 and 2020, while Brazil's averaged 17.1%. Introducing NRP in such environment could trigger capital flights as investors seek higher yields elsewhere, leading to sharp currency depreciations and further inflationary pressures. During the taper tantrum of 2013, for example, both India and Brazil experienced massive outflows in currency declines simply due to expectation of tighter US monetary policy. Additionally, the banking sectors in this country relies heavily on net interest margin for profitability, and negative interest could strain their balance sheet, reducing their ability to lend. According to the World Bank, over 60% of the bank profit in emerging markets come from interest income, compared to less than 40% in advanced economies. In summary, while NIRP may be feasible in low inflation, stable economies it is ill suited to macroeconomic realities of most emerging markets.
Thank you, Ishi. The number you have shared make it clear that the risks of NIRP in emerging economics far outweigh the potential benefits. The experiences of India and Brazil during the episodes of capital outflow highlight just how sensitive these markets are to the global monetary conditions. It's a very powerful reminder that unconventional tools must be carefully tailored to the specific context of each economy. Next to Ishi Captain, is there a downside to central banks committing too strongly to guidance?
Absolutely. There are significant risks when central banks commit too rigidly to forward guidance. While clear and credible communication can anchor expectations and enhance policy effectiveness, overly strong or unconditional commitments can backfire. If unexpected economic shocks occur, such as sudden spike in inflation or a financial crisis, central banks may feel locked in by their previous promises, delaying necessary policy adjustment. A notable example is the European Central Bank in 2011, which raised interest rates in response to inflationary pressures, only to reverse course shortly afterward as the European criticized deepened. This episode undermines the ECB's credibility and contributed to market volatility. According to a 2022 study by the Bank of England, central bank that issued highly specific, time-based guidance were more likely to face credibility challenges when economic conditions. In the US, the Federal Reserve's experience in 2013, when hints of tempering quantitative easing led to a sharp market sell-off known as the taper tantrum, illustrates the danger of miscommunication. Therefore, forward guidance must be flexible, data-dependent, and contingent on evolving economic conditions to avoid unintended consequences.
Thank you, Ishi Calvin. Your analysis and the historical examples you provided really drive home the importance of flexibility in central bank communication. The data on credibility challenges and the market reaction show that even well-intended guidance can have negative effects if it's too rigid. This underscores the need for a central bank to strike a balance between clarity and adaptability in their forward guidance. And how do small economies like Bhutan, for instance, experience indirect impact? This question is to Michelle.
However, to add upon your views, Ishi, I think there are risks to the normalization. Markets may become addicted to central bank support, expecting intervention at every sign of troubles. This phenomenon is called moral hazard. Fiscal dominance, where monetary policy becomes subservient to government borrowing need, is another concern. As for NIRP, its long-term sustainability is questionable given the challenges it possesses to bank profitability and financial stability. Forward guidance, on the other hand, is likely here to stay, but will need to evolve with advances in communication, technology, and greater transparency. In summary, unconventional monetary policy are now permanent features of monetary landscape, but their use may be judicious and complemented by sound macroeconomic policies.
Thank you to all our panelists for their thoughtful insight today. Finally, to wrap up with, I would like to invite all the panelists to share their perspective on whether unconventional monetary policies have become permanent instrument in their monetary policy toolkits. Thank you all the viewers for joining us in this discussion. We hope it provided clarity on the evolving role of central bank in today's complex world. For follow-ups or question, feel free to reach out. Until next time, goodbye and take care. Thank you. The data on central bank balance sheet and the repeated use of these tools make it clear that UMPs are no longer just for emergencies. They are the integral to modern monetary policy. But as you have both pointed out, their normalization brings new challenges, including market expectations and the risk of policy overreach. It will be fascinating to see how central bank adopts this tool in the years ahead.
Unconventional tools, unprecedented times, rethinking monetary policy for a resilient future.